Hello. Hi, Jimmy. Hi.
Hello, hello guys. Hello, Mohammed. Hello, Jaime. How are you?
Hello, guys. Thank you very
Yeah,
much for inviting me.
and
That's
thank
our
you for being
pleasure.
here. Yeah, our pleasure.
Yeah,
Exactly.
yeah. Okay, so let's start with just a quick introduction about Kugya. And we'll start on our topic directly right away. Kugya is the one-stop shop for entrepreneurs that helps entrepreneurs or anyone has an idea to convert it to a tangible product. Simply, we're building MVPs, we're doing the validations of your ideas or entrepreneurs' ideas, and we're taking your hand to execute and make a success out of your idea from the very early at the beginning till you have the success you need by getting tractions, getting revenues, or even make you ready to get your raising fund. Thank you, Jamie, for being with us. Yani the expert we have in the finance, whenever we're talking about finance, Jamie is the first and best person we can talk with about the finance part. I'll let you introduce yourself, let the audience know about you and about the Startup CFO.
Perfect. Thank you very much again. So about me, my background is in consulting. I worked at McKinsey for a year and a half, and then it's when I moved to startups. I always worked in the finance area of startups. So then, little by little, I started helping friends or former colleagues as freelancer with the finance area. So like with fundraising, with reporting, with like how to deal with investors, with the processes, anything related to finance. And then little by little, that side business started growing and growing. And at some point in 2020, I started the Startup CFO as a company. So the objective was to scale the service. And by today, we are a team of 30 people. We have served over 200 clients in over 20 countries. And well, our headquarters are in Spain, but we also have a branch in Germany, in Berlin. So, and yet, well, our main focus is still the fractional CFO services, very similar to when I was a freelancer. Although we also do accounting, we also do legal, even public funding applications, and some other related services.
Interesting.
Right.
That's a great achievements and success you have.
Yeah, I
Amazing.
guess that, I mean, our clients are always startups, like typical venture capital startups that have raised between maybe 1 and 15 million, something like that. On that end, I'm entrepreneur, but not the startup type. So like we ourselves, we do not have a venture capital money. I don't think it's a business model that would need it. But
Mhm.
yeah, all our clients are essentially in that field.
In that space.
Interesting.
Right.
Mhm.
Great. Let's have the main goal of the discussion today. We know all the changes and the challenges the startups and businesses were facing since 2020, the pandemic, and all the economical challenges we're facing. What or how the startups should adopt their financial models to be able to robust and be resisting or have the resilience for their business and startups during these changes in 2024.
I see. So I would say that in general, it's not so much what to change in terms of financial modeling, but rather like what scenario should we count on. So we always say that startups should aim, well, in general, every company, I would say, aim for the optimistic case and set objectives according to the optimistic case, then make decisions according to the realistic case, and then finance the startup for the worst case. So this is often not followed, although it should, especially during fundraising. During fundraising, you usually want to claim like, okay, we're gonna do amazing, but the problem is like you should not ask for the amount of money for like if everything goes amazing. So you should ask for more than that, like create your realistic scenario, how much you need, create your pessimistic scenario, how much you will need, and then create the funding round accordingly. So that, in my opinion, this best practice of aim for the best case, make decisions to a realistic, finance yourself for the worst, should happen in good or bad times. The problem is that now we think that many startups are going to see or like just faced how they had to have planned for the worst in terms of financing. If they didn't, they're struggling. And in the future, that's the scenario. Also, even in the base case scenario now, I think changed a bit. In the past, the base case scenario, we could contemplate that another funding round could happen in 12 to 18 months. And I think that now a base case scenario should go to 24 months runway probably, because the next funding round it will not be as easy to get as it was 2 years ago. And
Mhm.
in terms of business modeling, I would say that again, like not to forget like what startups are about. Startups are about removing uncertainty on like a new product or service, and startups are about unit economics that can be replicated over and over and over again. So
Mhm.
the control on robust unit economics and on true unit economics that are replicable before investing in growth, it's always key, but especially in times where funding is not going to be as free in the future.
Interesting. But yani, I have a follow-up point for this. Some in an early stage for startups and entrepreneurs, they might lack the experience and knowledge on how to have these three scenarios of their business, like the worst case and best case
Mhm.
or the moderate case. What advice you can tell us or tell the entrepreneurs or startups to consider that can help them identify what is the worst case? Because sometimes the worst case is just shut down the business. But
Yeah,
we
no,
don't
I
mean
agree.
shut downing the business.
So yeah, I think, well, we usually work with two types of founders. I would say that you can, in general, create two big categories of founders. The ones that are super technical, they know a lot about their products, they know a lot about their technology, they know a lot about their market, but often these guys are not truly like finance oriented, and they
Or
will not do.
business oriented, or yeah, yeah.
Exactly. And then the type that is like more former investment banker, former consultant, business profile, a serial entrepreneur that has done like the business part in other business. So it's the second one, certainly in very early stages, I think can like figure out by themselves, and then at least like some numbers. I think it's helpful if they are done by the founder, by the CEO, and maybe not like the day to day, but certainly like at least the first business model. And then for the technical guys, I would tell them to seek for help. I mean, I'm not trying to oversell, but I believe in the in our message. Like the CEO's time is very, very, very worth it. And a guy that is a super expert in AI, it's wasting his time like with an Excel file that things don't add up, or like the needs to plan, the relationship with the taxes and the cash flow. He's just wasting time. He's gonna leave that job for Friday evening. In the end, he's not gonna do it, or he's gonna have mistakes, or so just ask for help. And when you mentioned the worst case scenario, being shutting down, that's absolutely true. But when planning, at least like people tend to put everything that is optimistic together. So like this client that we recently talked to, I think they could close in 3 months. And if it's a big corporate, it's much more likely it's going to be 6 months. So like then for the realistic, put 6, and for the pessimistic, put 9. So it's like put those parameters like not all pessimistic, not all optimistic, but like with some trends, and then you can already see like, okay, if that client comes in 9 months, then I would better ask for 500,000 rather than 300,000 to start, or I better hire this marketing agency in June rather than in April. I'm making it up, of course, but I think like it's more about like the natural feeling that we get of optimistic, realistic, and pessimistic than pure finance, I'd say.
Yeah.
Interesting. Nice.
And do you see like there's what kind of like innovative like fundraising strategy a startup can put in place to attract right now in our days like investors? Like do they have to like go for big numbers to ask, or maybe like segment the fundraising, or another like kind of innovative strategy you've put in place with your clients, of course, but what do you recommend like to go nowadays?
So I would say that there's one part that is innovative, certainly, and it's about funding alternatives that I will mention now. And another part is, again, similar than before, like the best practice still holds, but the focus is different. So in terms of what's innovative, for example, I think an underused new funding source, it's a revenue-based funding. So revenue-based funding, in a nutshell, is like, okay, I'll give you 100,000, and then you have to pay me back 120,000 with 5% of your revenue each month, for example. So it's not a fixed term, it's not a fixed payment, but it's flexible. It's like, okay, whatever your revenues are, I get a cut until you have paid me back the original amount and some more. That's, for example, an alternative that is very recent. I'd say that it started being popular. Well, it started to like enter, at least in Europe, like 4 years ago. I would say 3 or 4 years ago, 4, and then becoming popular like 1 or 2 years ago. So the first thing would be like, are you truly like in the need of private capital fundraising? So either you can get alternative funding by venture debt, by like revenue-based funding, public funding as well, like got much more popular since COVID, for example, and there are many more alternatives in most countries since COVID.
Or even
Well, second, do you really need funding at all, and not bootstrapping? That I think we'll talk later about it. And the third one, if you are going like for a venture capital fund, then again, like you need a plan like always, but the focus is going to be much more on profitability than in growth. And the focus is going to be much very focused on unit economics. So in this, actually, there are several analyses. I don't know. I remember I saw one that was pretty good some days ago. I don't remember the source that showed how investors are valuing much more profitability over growth than they used to. It used to be the opposite. So on
Yes.
that, definitely there's no longer like we're gonna multiply by 10 and who knows what happens later, but rather
Mm.
like we're gonna multiply by 3 and then profitability is on site since
Yeah, you're
everything.
right. That's the trend we see more and more, even on our discussions, even during the episode. It's like it's coming back to get like really distraction. Like your first clients, your first paid customers are very important for the investors. And then even if it's slower, but at least you prove you have revenue, really your market fit. This is a baseline that it confirms what you're saying. Like very focusing on these and just not like selling a dream or a dream business model or financial models. We're coming back to something very like what we call like pragmatic
Agree.
models. Yeah,
Yeah, I'd say that yeah, like in like it reminds me a lot of 2019, for example, when WeWork crashed for the first time actually.
yeah,
Then a lot of investors, a lot of VCs, and therefore a lot of startups started focusing much more on profitability. And I think, I mean, startups have like super quick cycles. And this reminds me more or less to that. Like suddenly overnight, we all care about profitability
yeah.
again. And also something that we see that is the mistake that I think most startups make in Series A, especially, is to try to scale before they have truly found product market fit. So finding product market fit is not finding like just two clients. You can probably build any product, can find two clients. Yeah.
Right. And I would say, but I see like also finding it's very interesting. Just like or because sometimes you have two clients, but the clients are like your friends or just referral.
Yeah.
It's not what we
Oh,
say with Mohammed. It's not real clients are the ones you don't know. They're not from your and these are the
exactly.
good.
Yeah, this also is very tricky with unit economics. So we focus a lot on that, and I mentioned already. And I mean, well, in general for the audience, the most important is the lifetime value, like the margin that the client is gonna bring you over time. You estimate a lifetime based on the churn, and then like the margin that is gonna give you, and then divided by the acquisition cost of each client. So the
Mm.
total sales and marketing cost divided by the clients that you acquire. So this metric, the proportion of LTV over CAC, lifetime value over acquisition cost, it's considered to be healthy above 3. Yeah, this is like a market standard. But very often we see that early stage startups, they show off that is 30. And to me, if it's 30, I don't believe it. Why? Because it's not scalable.
Yeah.
So no one has invented the business in which a very low paid intern can sell 5 Ferraris per day. Yeah, it's impossible. So the acquisition cost is tied to the lifetime value. And if it is a 30, it's like, okay, you have a non-scalable business by now because it's the time of the CEO, the connections of the CEO very often, a tiny market, but it doesn't mean that if you put, 100 times more money, you're going to get 100 times more clients. No, because the clients come from the CEO and that doesn't scale. So we see that the most common mistake is to try to go like, okay, let's get a lot of money. Let's put a lot of money in marketing and sales. Let's grow the team. Let's go crazy. When really you haven't tested that 10 times more money brings 10 times more client, or at least 8 times
True. Very
more
true.
client, or something like that.
Totally.
Yeah, honestly, this is very close for our conversations we have with some clients or even some friends. Whenever we're building businesses and startups, we're building something for customers, not for us. That's the main
Exactly.
challenge.
Well, yeah, that's we have a client that he claims that his product is 10 times better than Tableau. Tableau
Yeah.
was sold for 26 billion, and this guy is in seed stage since 4 years ago. So to me, it's like I'm not sure if you're building something for yourself or for a huge market. And by the way, I mean I understand that example is very extreme, but I understand, for example, the unit economics example I made, or this mistake, because many times again the CEOs cannot be experts on everything.
True.
They often like don't know about unit economics before starting. They know a lot about artificial intelligence again, about like whatever a huge market that is expanding, about mobile apps, about marketing, about whatever. But
Mm.
that's why I said like count on help, because otherwise you're gonna go to a funding round thinking that the funding round is the objective, and the funding round is means for an objective. But
Yeah.
you see that every time it's like congrats, to the huge rounds, and I understand that it's a lot of effort and people were like spending a lot of time on it, and then therefore to say congrats. Okay, you have been trying to get this for a long time. It was very difficult, and you got it. But it's not the objective by itself. So
True.
many companies that don't know about these very important financial concepts, they just go to the vanity metric of saying like how much money we have raised before doing the homework on the finance area.
Right, just I'll let Mohammed go to the question. Just to, I would just want to jump on that. It's like exactly what you were saying. Like a fundraising asks a lot of efforts, and if you're putting efforts on your fundraising, you cannot put as much effort on your business and to sell your product and services. And that's all the balance and the challenge to find. Is like I go fundraising. Just be aware for entrepreneur or startup founders. A fundraising is a lot of work, a lot of efforts. And if you do that and you don't have a huge team because you don't have it yet, you defocus on selling your own services and products. So they have to find the balance.
There's an opportunity cost certainly. So in fact, in the reporting of our clients, and I'm not joking, in many of them you see that they were growing, then they're flat and they
Uh-huh.
grow. And you can identify that this is when
When
they
is the
were
fundraising
fundraising.
part? Yeah.
I'm not kidding. Like this we've seen it like very, very often. Yeah, absolutely.
That's crazy. I think yani, the pandemic or all of these changes get in the mind of all the business and the startups and entrepreneurs to think about cost management. It's not easy to get fund now, and it's more the time of managing our cost effectively. Or what in that case, what are the strategies you can suggest or advise businesses and startups to think about to minimize or cut the cost down wisely
Mhm.
without affecting the business itself for sure, but at least to extend their runway more time and have the growth, even it's not that's huge growth that happens just after the raising fund rounds, but at least to make the businesses going in the sustainable way.
Yeah, I think there's two parts on the story. Like one of them is like not raising the cost too much first, and second, what to do to reduce cost. So, for example, we often see that startups raise too much money, more money than they need,
Ah,
because
Mhm.
it's again a vanity metric. It's cooler to say that you have raised 10 million than to objectively. So then very often they say like, okay, we want 10 million. To justify that, then you do like a very aggressive business plan on revenue. But of course, these revenues are going to bring cash to the company. In theory, are going to bring collections to the company. So on top of that, you need to justify that you need 10 million.
yeah, the cost.
Then you have to put that you are going to spend like crazy.
Yeah.
So
Mhm.
what ends up happening that many times companies start investing like crazy too fast and too uncontrolled, but then the revenues don't go that quickly again because they were like all the optimistic, absolutely in the optimistic case. So first of all, I would say like the best way to reduce cost is not incur on unneeded cost on a first place. Yeah, absolutely. And too fast. And people think that like very big rounds will last forever, but we have seen many companies burning a lot of money per month. So
Yeah.
that like control the cost when growing, that's the first part. And the second part, when reducing cost, and this is the most painful, very often people think about the operating cost and not about the personnel cost. So for example, they could say, I'm making it up, let's buy laptops that cost 700 euros rather than 900 euros, for example. But then at the same time, they don't reduce the hiring plan. And there's usually not a single invoice in our clients that is bigger than the average cost of an employee. So they're
Mhm.
telling you like, we're gonna save in the summer event, we're gonna save 10%, but then at the same time they hire 5 people. And you're like, okay, the expensive, like the most expensive thing almost always, almost in every company is the
Is the
unit of
is the
employee. And
employee
of course it's
wages.
painful. Yeah, of course it's painful because it's also the unit that can bring you more revenue. But and especially if you need to cut costs, firing is not fun to anyone. So,
Yeah.
but yeah, it's like okay, then avoid it at the first place. That's the healthy part that you don't need to be like, okay, we need to reduce costs now, or we are dead in 3 months. Like Try to avoid getting there and keep always your runway far as you move on.
Yeah.
Interesting.
Yeah, and we talked about like a lot of these financial forecasting and the best practice. So you said like all the three scenarios: worst, best case scenario, the like realistic, and then the worst case scenario. And it's like how important like the investors, the VC, how on which one they look at, and do you have and how much this is important to build on. And now, do you think they more look like on your side, do you think like the best case scenario they put the penalty and you have to stick to the realistic one, or you still have to plan the three scenarios uh, still?
Okay, so the way we would do it, and this, I mean, depends as well on like the funding conditions of the company. But we usually fix at the beginning of the year a business plan that is like mostly optimistic, not crazy, but optimistic. That we say, especially on revenue, that we are like, okay, this is gonna be the objective for the team. This is gonna be the objective for the bonuses. Personally, I prefer to be like realistic for the bonus. For example, I'd rather pay bonus and make sure that we can say, okay, we hit the target and we like went even higher, for example. But that's more on HR strategy. But yeah, like I'd rather say like at the beginning of the year, let's hire a VP that is ambitious that will make us make decisions. By the way, so many startups are like, okay, imagine new clients per month. We have like two, and then from now on, we're going to do three, four, five, six, seven. But they don't have any initiative to make that happen. And if it has been two forever and you're not planning on changing anything, that's probably going to keep being two. The average ticket is very similar. So until now, it's 1,000 per month. And then from now on, it's going to be 1,100, 1,200, 1,300, 1,700, and 2,000. So on many of these is like, okay, do an optimistic business plan, do a like an ambitious business plan, but still that all the levers, all the KPIs that like play a role in building up the revenue make some sense, or you can explain why. Then of course things may take longer than expected or whatever. But in any case, that's the base case that the business plan, the optimistic case, that we freeze, and then during the year we will compare to that. We will compare to our objectives, and we will see what KPI we are not meeting, so we are not meeting the objective, or the other way around. But in any case, we're comparing the actual numbers to the business plan that we froze at the beginning of the year, and then we're gonna keep an always updated, realistic forecast.
Realistic, okay, yeah. So
So for
it's like you
example,
keep like the good case scenario always there, but the baseline is the realistic. This is the one you track on the daily basis to catch up maybe the positive one, the good case.
exactly. So maybe on December 31st, we like do a version that is optimistic, and we say this is gonna be the business plan of the coming year. But immediately we say like, okay, fine, but like the forecast is the realistic one, you know. And the
Yeah.
forecast is updated every month, like new actual numbers. So then you have an updated forecast, more information. Then a new month, and then an updated forecast. And that one, you should never keep your eye out of it, especially in times of uncertainty, like we were saying before.
Yeah, I think yani, this could be one of the main sources of stress, financial stress for business owners or businesses. How do you see the business owners and startups owners can manage this type of financial stress, especially with during the downturn economical time and the lack of investor type that was looking for just growth, not just getting revenues or traction?
Yeah. I guess it's similar than the question about the cost management. It's like the best way to deal with financial stress is not needing to deal with financial stress at some point. So here there's a lever, for example, that fewer startups use that is a leverage with banks, for example. So the banks, in my opinion, lend you money when you don't need it. This is like the objective of banks. It's like if you have €1 in the bank, they're not gonna lend you much. If you have 2 million in the bank, they are nicer. And this, I mean, besides the joke, it makes sense. So no one, very often we get founders that say, okay, I have an idea, like I'll go to the bank and ask for 1 million. And it's like, man, no one will give you 1 million now to get maybe €50,000 with such a high risk. So at the beginning, you need to finance your project with 100% equity. Later on, if you are a huge corporation, imagine you're a huge corporate, Amazon, whatever, they ask for debt, and of course you give them debt. Like they're a huge corporation that grows and has like there's no uncertainty anymore. There's like a normal business, and there's a gray area in between. So, for example, once you have raised a couple of million, when you have raised even 1 million, I would start asking for bank funding at in the moment that your financials look the healthiest. So the moment
Not,
that 2
not
million
at the
hit your
beginning.
account,
Not at the beginning that you raised, like to leverage, or do you do that like, okay, you got 1 million in equity and you leverage immediately, like with a loan or a debt?
right?
Do you do it now, or you wait a little bit? Because if you wait and then you've already used, I don't know, 500,000, you're maybe not in a great position. What's your
Exactly. So I would say right after raising the round. So that moment is when your financials are the healthiest. You have a lot of cash in the bank and everything looks good. So that day, they're going to give you, imagine, maybe like 10, 20% of the amount that you raised. And of course, for a while, and I know this, you're going to be paying interest for a money that just sits in your account. But very, very often, if that loan, for example, was for 4 years, then at the end, you're going to have maybe like 3 more months of runway that may mean the difference between life and death. And if you do this right, this may depend on the country, but like if you do this right, you don't have a personal liability. It's only the
yeah,
company.
that's very important to raise. Like, let's flag it for the audience or entrepreneurs. Be careful on the personal liabilities on the loan.
Exactly.
I saw bad stories about it. Like, okay, because I'm so optimistic, I trust in my startup, nothing bad will happen because I have a great idea. Like, they fall in love their idea. Be careful of personal
We
great
say
liability.
never, never, ever, ever put a personal collateral on it. So like your home or your personal worth or your whatever, not at all. And if you see that the company is like struggling, then talk to a lawyer such that you can figure out how to do it or how to do the winding down of the company such that you don't have any personal liability. But if you do these things carefully, well, and like well advised, then debt may extend your runway, and that's one way. Second, leverage in general any other way of non-diluting funding. For example, public funding.
Yeah,
Again,
grants.
many people remember public funding when they have 3 month runway, and only
Yeah.
the applications usually last 6 months. So do it when you have money. Think
Yeah.
about all the alternative sources, for example.
I
So
think
this way you don't have like, I mean, you lower the risk of being like financially stressed. And also, if you keep a constantly updated forecast, and then you see like, okay, it looks like 6 months from now, like if we don't get this client, then like it will go down and stuff. That will help you anticipate all this, of course.
I think that that's exactly one of the advices we always give for our clients. Just it's a mindset, the mindset of just looking for collecting cash from investors should be turned to be just focusing on getting customers and make this stress on the financial part not for just raising fund, but at least to make sure the cash flow is started to be in a positive way. You started to get convincing some to the customers, not the investors.
Yeah,
That's
and very often clients get to us because now they have professional investors on board, and they ask them for some reporting, and then they tell like, okay, please prepare the reporting for the investors. But we are like, the reporting should not be for the investors, it should be to you guys that are the management of the company. You should not compile the numbers yourself, that like delegated in an expert, but definitely then analyze them and make your decisions according to those numbers. Of course, in
True.
the end, it's like back to common sense. But I guess in the middle of this like crazy startup life and growth and news and like so many inputs, I guess it's useful to remind it.
Interesting.
And
Nice.
yeah, and that's how for you do you maintain, like as you were saying, like for example, you're not achieving the KPIs you were talking about, like how do you maintain a healthy relationship with your investors, VC, and not like not willing to hide some numbers under the carpet, or like being scared of like, okay, I didn't, the KPI that you were saying it's for you, but you're going to have to show them. How do you how yeah, and the CEO, the entrepreneur stays strong and say maybe the advice to have like maintain this healthy relation. Okay, they trusted me. I've sold them this best case scenario financial
Yeah.
model. I'm not to it. Let's say I didn't get it. How do you keep like a good relationship with them?
Mhm.
Sure.
So we very often see entrepreneurs, especially young entrepreneurs, that have an unhealthy relationship with their board or with their investors because they see it like boss report a scenario. You know,
Yeah.
like the boss is the investor and I report to them. And in my opinion, again, taking a step back, it's you guys are partners in the beautiful sense of the word. You guys should be aligned. By the way, if you are going to partner with a VC, you should know that they want 1 out of 20 that does amazing at the expense of the other 19. If you also have that risk reward profile, go ahead. If you want 1 in 3 chances that this goes pretty good, maybe you should not partner with someone that has different incentives. But if you did, and if you guys are the right couple, if you guys are like more or less aligned, then like forget about like this one on top of the other relationship. You guys are partners, and you guys the same. You guys have the same objective. So this, I remember like once a company that was our client and they were profitable, by the way, and one VC had 10% of the shares. And they were like, yeah, but the VC wants us, yeah, but the VC told us, and then at some point I told them like, guys, you have 90%. And here on Mondays, it's only you guys that like give the orders in the company, you know. So don't be too crazy about it. And then, and another temptation for many clients is I don't want to show numbers because they are not as good as I said. But this is childish behavior. You know, it's like, okay, it will show up. It's like putting it under the carpet. And and then an alternative to this that is very common, especially in early stages, is what it's called the audacity of zero. So, for example, many companies may not want to start charging their clients because, you know, like if you say you are not trying, if you say you're not trying, if you say like you're not charging anything because you don't want, then the dream is still as big as you want it to be. You know, like from 0 to 1 billion seems like less distance than from 100,000 to 10 million. Yeah. But this, in my opinion, again, is short-lived, and then like the more you learn, the better. And the way to learn and remove uncertainty, the way to learn is to test it and to test with real fire with clients. So this is also something that we see many people reporting to themselves and to investors. They want to keep that magic, to put it that way.
Yeah. You're on mute. Mohammed, you're on mute.
Yeah, yeah. Sorry. I just
I
need to
see.
remind our audience that they can just add their questions in the comments, and we can get back to the questions by the end.
Mhm.
That moving after the in how to manage the relation with investors, one of the main directions that most of the mentors give for the startups and early stage entrepreneurs just to focus on one revenue stream or one channel to make revenue. However, now there is another rising school just to encourage people to have a diversified revenue streams. The
Mhm.
question is, what do you think about this? Is it healthy for a business or not? And if you promote for this as well, like me, I like this. What the proper strategy to do this or the right time to do it without affecting the business negatively?
Mhm. I would say it's an hourglass shape. So I would say on day one, On day one, certainly, I would say yes to everything. To be honest, this is what I did with consulting. So at the beginning, like any type of more or less consulting project I could do, or like I heard of someone like asking in finance or even like strategy or like other things, I said like absolutely with startups, with SMEs, with like I said yes to everything. And very quickly, I realized that I had to be, like the thing I knew how to do was startup and was finance. So then I think in general, any business at the beginning, you're attacking a huge market that has an inefficiency. So probably you are not like that inefficiency exists because something that you don't know. So like at the beginning, you can like try different things and then figure out why some of them don't work, but some will. So then I would say at the very beginning to say yes to everything and to try a bit, then focus on what you can find like true unit economics that are replicable and that stuff. In that's like seed, and then that I would say is seed. Then in Series A, try to scale that and maybe already try some other sources of revenue that then may be different countries, different sectors, or like even like byproducts. So I really like, for example, in business decks, when they have like an iceberg approach. Like, I'm gonna tell you, like, this is already a very good opportunity. This is already something I know of. This is already that we have tested and makes sense. And stuff. But, like, don't worry, there is like a lot of it. Like, if we ever want, like, this is already big. But if one day we really want to go crazy, there's so much more that we could do.
Mm.
So I would say like time it with the right, like time it with the phase of the startup. Pre-seed, figure out something. Seed is like seek product market fit. Series A, scale that. Series B is growth. So I would say like in end of Series A and Series B is when you should open it again.
And how do the investors see that? Like for example, as you were saying, like you for example, Jaime, your startup is creating a SaaS financial tool, but at the same time you can do consulting, and then you see that you're getting money from the consulting, but the business plan you sold to the investors is your SaaS product because this is very scalable. Is this
Yeah.
like, but you said, okay, but I've done that to make cash flow and make money come. Does the investor will look at it like, okay, but no, but we prefer that you had focused on the SaaS, or they would say, oh, congrats, Jamie, you had some cash that came in. That's a good way, and then now you're figure out other things. What do you think? Because I saw that a lot.
I'm I'm very favorable to these like other sources, non-scalable or like non-product sources of revenue, especially for SaaS businesses. To be honest, in my opinion, that's the way that you can learn and optimize and automatize later on. If you guys notice, I've used the words learn or remove uncertainty 1,000 times already. And it's because it's the key in a startup. If you truly want to solve an inefficiency in a huge market, there's something there that you don't know. So certainly you should like I think it's healthy to do consulting and then translate it to a product. Of course, there needs to be a translation, and like there needs to be like a clear objective of why it's a proof of concept. So, but yeah, I'm absolutely favorable. We see that in many SaaS companies, even that are mature, around 10% of the revenue comes from consulting. And if it's more than that at the beginning, in my opinion, if it helps you remove uncertainty and it helps you build a better product later that fits better with its market, then absolutely happy to see. And by the way, it's a form of financing. Many companies like forget that revenue is the best source of financing. Non-dilutive, you don't need to apply for it, you don't need to give it back. So, and this we see, and I'm not kidding that many companies like forget about it.
Very right, but we see that a lot. Like you're on something innovative, you want to keep to it, but then you see the path. Like okay, having like services less innovative, like it's easier to sell maybe, and oh, let's focus on that, and then you defocus on your innovation, and that's all
Mhm.
the balance. You're right. It's not easy. It's not easy to do it when you have
No,
like
absolutely.
you
Also,
sell like consulting
it's
services
much
or
easier. It's much easier to talk from here than when you have cash going down, of course, and investors here. Like that. Absolutely. I understand many of these mistakes. The point is like then focus on what you don't make mistakes at, and then count on help on people that are experts, but they don't know what you're saying.
Yeah, I'm saying that because that's also something I encountered in one
Yeah,
of my venture. Like I was like, oh, I know the thing that can make some cash coming in, and then I went to it and then slowed down the other thing. So I know it's not easy because you're attracted to get cash more easily.
no,
That's a common.
and I'm sure a marketing guy would laugh at like 1,000 mistakes I would make. But then, yes, I have a marketing department with people that know more than me, and I hope that then we make less mistakes. It's common sense in the end.
And we talked about we talked about like a risk, like putting on yourself like your own liabilities on something. But what are the risks you would say to a startup founder or entrepreneur, like to be aware, what a kind of financial risk to be aware of and like not do, or like or like big flag, what, or one or two big flags you would see on that?
I would say there's one that applies more to common businesses than to startups. That is the raise of interest rates. So I was mentioning before that debt is something I would encourage in a startup, and still, even if there's high interest rates, I would encourage to get. Why? Because the alternative is equity. So if a startup needed, imagine a successful startup that goes through 3 funding rounds, if they needed to buy all the equity they receive now, they would buy like much more expensive than they got it. Like now, like the
Yeah,
200,000 they gave them 2 years ago, now they are worth like
value of
more.
the money is yeah, of course, yeah.
Exactly. So, okay, maybe interest rates are higher, and this for a normal business that doesn't depend on funding rounds is like very important if the debt is more expensive. And no, but for a startup, to be honest, I would say that this is not so much. I think the biggest risk is you may not get another funding round if you were expecting. So ideally, this worst case scenario, not all startups can achieve it. I will explain. But this worst case scenario of like finance yourself for the pessimistic case, ideally should be what it's called that default alive option. So even if we didn't get any external funding ever, we could still be alive. So that is the best. And this, for example, many SaaS businesses that already have like over 1 or 2 million revenue, they usually can achieve that. Obviously, painfully, they may need to fire half of their development team and half of their sales team. But yeah, like there should be a plan of like we are default alive. A very early stage startup usually can't get there because your revenue cannot make up for the cost at all. But if you are a bit mature, having that as your worst case scenario, as your pessimistic scenario, it's the healthiest way to mitigate that risk.
Interesting. I think this could be the one of the long-term financial visions for any business, just to have the financial risk management skill and strategy to minimize and reduce the expected risk that might happen for the business. This was something we're discussing, that sometimes businesses were not having in their worst case scenario that the whole world will be affected by something like the pandemic. But now it's realistic, and all of us are experiencing this, and now it's very normal to have this kind of big huge risk that could affect all of us. But
Mhm.
how do you think and see what are the other aspects of the long-term financial vision for businesses, especially at the early stage? The feasibility at the beginning is not that clear. All the plans based on um, forecasts, based on optimistic things, not realistic, no historical data to build on. But in that early stage or even the mid stage of any startup and business, how can we have a long-term vision from a financial perspective for a scalable and growing business, even against this kind of global phenomenon that might affect the businesses like the pandemic or whatever thing?
So I guess it's having a back to basics and like start with the long term and then focus on the midterm. So in the long term, like a startup is based on there are units that are profitable and that can be replicated forever. at many different levels, by the way. For example, Uber. Uber needs to have clients that are profitable, like you acquire them for X and they are going to return Y. So, and then you have like not infinite, but a huge amount of potential clients. Then on the driver side, you have drivers, you need to acquire them, and then they will bring you X amount of money. There's a less number, but of course, many people that can be Uber drivers. But then also at a city level. At a city level, you open it, and at the beginning, you're burning money on marketing, subsidizing trips, overpaying drivers. And at some point, it should like pick up. And even at a country level, it's the same. Like maybe the first cities are not profitable, but at some point, the new cities cover the old cities. So, like, what are the units? Is this truly something profitable? Could this, even if you're just starting, could this be profitable? Like with more or less like realistic forecast, but again, not even like complicated Excel forecast, like some hypothesis. It could, and then is there a very high number of units? You know, Netflix, for example. Netflix, its user probably has like a 90% gross margin. How many potential users do you have? Billion. So it's like, okay, check. Like in the long term, it's like, okay, I can have units with relatively low fixed costs that I can like keep building and acquiring and recurrent, so they add up to on each other. Like, does that make sense as long-term vision? Yes or no? Because if you are doing a software for only veterinaries for fish, okay, your market is way smaller.
It's niche.
Exactly. It's like,
Yeah.
okay, maybe it's not a startup. Again, that doesn't mean that it's not a good business model, but maybe it's not a startup in the traditional. And then in the midterm, you should be very clear on what you want the round for. Because many times it's just like fuel. You know, like, okay, like it would be great to have money. But it's like, what's the next uncertainty you're trying to remove? That you can scale, that you can open in another country, that you can keep acquiring in the market, that you can keep acquiring market beyond the CEO, network. So take one at a time, because many companies try to focus on 10 things, and that's impossible. Take one at a time, and then plan yourself and ask for money for this midterm and what you want to improve. And you have X numbers of pivoting that you can do or of different tests with that money. For example, SpaceX, they had money for 4 tests, you know, and the fourth one went right, you know, and they changed things like in the middle. Usually with normal companies, it's not so clear, like the number of tests, but at the end, it's the exact same like. So you raise the right amount of money and use it to remove uncertainty with some objective and pivot until you get there and then move on. If you do that well, you should have a default type option always or almost always.
Interesting. To this point, we have a question from one of our audience. It's a bit challenging because I even had this question in my mind long time ago. Do I need to have a financial advisor to help me on the finance part, or to help me is for fundraising? And if the answer is yes, I know the answer is yes. But what are the requirements should I be preparing, or what are the checklist components that I need to get ready whenever I'm talking to a financial advisor or financial expert like or your company?
I see. I would split financial advisor in two parts. One is the recurring day to day, and the other one is
Yeah.
focusing on fundraising, M&A, and stuff like that.
Mhm.
On the second one, I'm not super confident, especially in later stages, because there are exceptions, and I will mention that. But very often, the best founders do not need those advisors. I mean, if it's a 50 million round, yes, everybody needs advisors. But like a very good founder with good track record, with good connections in the market, with good numbers and stuff, very often doesn't need a financial advisor for the round. What I mean with financial advisor for the round is, okay, sit down here, then I'm gonna go look for your 2 million to all investors on earth. Many times the investors don't even like that much because they're like, let's talk to it. In my opinion, there are exceptions. There are like cases, for example, in which the guy can be like super expert, but he used to work in a corporate, and now he's like, I don't know how to play this venture capital game. I'll get someone that helps me, and that's totally fine. In terms of recurrent advice, I would say at the very beginning is usually more expensive than what you need, like before seed stage or even after a small seed round. Then I think it's a good time to get someone external that helps. A full-time CFO is super expensive, and usually you will not need that person 5 days per week. You need a
Mhm.
junior guy to take care of
It
most
needs
of
to
the
be
tasks.
huge for that for a corporation. Yeah, right.
Exactly. Like
That,
you need a full-time guy to like, pay invoices and payroll, collect
Just
this and all
bookkeeping,
that.
can say.
Exactly. But then that person will not know enough usually to like go to a board of directors meeting and say this valuation doesn't make any sense. This KPI
Mhm.
does not follow the benchmark. We should not hire these three people now, but rather later. So I
Mhm.
think that's a good point to have an external advisor before a full-time CFO. And if things go amazing, of course, at some point you need a CFO.
Mhm.
In the finance department is funny because unlike the technology department, is usually built bottom up. So at the beginning you hire someone in admin, then some controller, then some financial plan analysis, and in the end the CFO. And I think this makes sense for the natural needs of the company along the way.
yeah.
Here.
Okay. Thanks. Thanks, Jamie. Yeah.
Thank you, Jimmy. And that was a great conversation. Very insightful, very helpful. I think the audience does not have more questions, but that's great for now. We might have more discussions about the raising fund challenges and about how to manage the financials for startups or even for running businesses. And that's, I think, the goal of all of our episodes of Kuya Go Big Seas. Now, I think, Damien, you need this is your part, the lovely thing at the end, uh, just
You
sharing
let me
some
all the time
words
do
about our
it.
launchpad.
Yeah, just before, thanks, Jaime, and thanks for your tips and the warnings and the things in mind. Like that's what we want to do also in this Go Big series. And like, okay, be careful or like warn on the things like to make entrepreneurs gain some time or maybe like one or two things from the talks popped in their head and stay. So thanks. I think there was a lot of insights in all what you said. So thanks
Great.
for
Thanks to you guys.
so yeah, so we're just at the end because we're as Mohammed said at the beginning, we're a startup studio with different services, but we just launched what we call the Entrepreneurs Launchpad. So we invest financially also and in services in some startups. With this spring batch 224, we're going to execute services in the business on the business part, on the marketing part, on the technology part, building the application, the web application, whatever it is, depending on the project, and also on the advisory part. So if you want to subscribe or to apply, you have this link, and we're going to receive you for the pitch and then explain everything on the Launchpad. You can also check on our website. Everything is explained. So the spring will start very soon. We take only 10 startups in this launchpad where we invest until the $90,000. So you can apply whenever you want. You have the link here, but you'll find it same thing on our website. Jaime is also a partner of us in this journey. So he's the one that you can back up or have the startup has a service part. So thanks the audience, and more than welcome for all entrepreneurs who had a great idea. We're here to hear the pitch. Thank you.
Thank you, Jimmy. Thank you, Damien.
Thank you.
Thank you guys. Bye bye.